Hey everyone, and welcome back to the channel. Today we're diving deep into the world of precious metals. We're going to unpack the latest trends in the gold and silver markets, explore the factors driving their prices, and try to figure out what might be coming next. Whether you're a seasoned investor or just curious about what's happening with these shiny assets, you've come to the right place. So grab a coffee, get comfortable, and let's get started. First up, let's talk about gold. The yellow metal has been on quite a journey recently. We've seen some significant price movements, and it's crucial to understand why. A major driver has been global economic uncertainty. When investors get nervous about things like inflation, geopolitical tensions, or potential recessions, they often turn to gold as a safe haven asset. It's like a financial security blanket. Think about it. Gold has been a store of value for thousands of years, and that long history gives people confidence. Another huge factor influencing the gold price is the policy of central banks, especially the U.S. Federal Reserve. When the Fed raises interest rates, it can make gold less attractive. Why? Because higher interest rates mean you can earn more interest by holding cash or bonds. Gold, on the other hand, doesn't pay any interest or dividends. So investors have to weigh the security of gold against the income they could get from other assets. Conversely, when the Fed signals that it might cut rates, gold tends to shine. The expectation of lower interest rates reduces the opportunity cost of holding gold, making it a more appealing investment. We've been watching the Fed's every move, and their recent statements have definitely been a key catalyst for the market. Let's not forget the US dollar. There's typically an inverse relationship between the dollar and gold. When the dollar weakens, it takes more dollars to buy an ounce of gold, so the price of gold goes up in dollar terms. And for investors holding other currencies, a weaker dollar makes gold cheaper, which can boost demand. We've seen some volatility in the dollar lately, and that's been directly reflected in gold's price action. Keeping an eye on the dollar index, or DXY, is a must for any gold watcher. Now, let's shift our focus over to silver. Silver is often called gold's little brother, but it has a personality all its own. It's a fascinating metal because it has a dual identity. Like gold, it's a precious metal and a safe haven asset. People buy silver coins and bars for the same reasons they buy gold, to protect their wealth. However, silver is also a critical industrial metal. It's used in everything from solar panels and electric vehicles to electronics and medical devices. This industrial demand component makes silver's price dynamics a bit more complex than gold's. Because of this industrial side, silver's price can be heavily influenced by the health of the global economy. When manufacturing and industrial activity are booming, demand for silver increases, which can push prices higher. On the flip side, if the economy slows down and industrial production wanes, silver demand can take a hit. So while gold is mostly a monetary story, silver is a story of both money and industry. This is why you'll sometimes see silver outperform gold during periods of strong economic growth. One of the most talked about metrics in the precious metals space is the gold-to-silver ratio. This ratio simply tells you how many ounces of silver it takes to buy 1 ounce of gold. Historically, this ratio has fluctuated quite a bit. When the ratio is high, it suggests that silver is undervalued relative to gold. When it's low, it suggests silver is overvalued. Many investors use this ratio as a timing tool. They might buy silver when the ratio is high, hoping it will fall, and then swap their silver for gold when the ratio is low. Currently, the ratio is at a level that has historically indicated that silver might have some catching up to do. It's definitely something to watch closely if you're trying to decide between the two metals. So, what's the outlook from here? For gold, a lot will depend on the path of inflation and interest rates. If inflation remains sticky, and central banks are forced to keep rates higher for longer, it could be a headwind for gold. But if we see a pivot towards rate cuts, or if geopolitical risks escalate, we could see another leg up for the yellow metal. It's also worth watching physical demand, especially from central banks in emerging markets. They have been accumulating gold at a record pace, and this provides a solid floor for the price. For silver, the outlook is tied to both the monetary environment and the green energy transition. The push towards solar power and electric vehicles is incredibly silver-intensive. As the world continues to move towards cleaner energy sources, the industrial demand for silver is expected to grow substantially. This creates a very strong long-term structural tailwind for the metal. So even if we face some short-term economic headwinds, the long-term industrial demand story for silver looks very compelling. Many analysts believe we are heading into a period of potential supply deficits, where demand outstrips new mine production, which would be very supportive for prices. Now, let's talk strategy. How can you get exposure to these metals? The most direct way is by buying physical bullion, coins and bars. This gives you direct ownership and you can hold it yourself. However, this comes with storage and security considerations. Another popular option is through exchange-traded funds or ETFs. Gold and silver ETFs like GLD and SLV are designed to track the price of the metal. They are very liquid and easy to trade in a standard brokerage account. This is a convenient way to get exposure without having to deal with the physical metal. You can also invest in the companies that mine gold and silver. Mining stocks can offer leveraged exposure to the metal's price. If the price of gold goes up by 10%, the profits of a mining company can go up by a much larger percentage, which can lead to a significant increase in its stock price. However, this leverage works both ways. Mining stocks also come with their own set of risks, like operational issues, political risks in the countries where they operate, and management performance. So, they tend to be more volatile than the metals themselves. It's important to do your homework and research individual companies before investing. So, to wrap things up, both gold and silver are in a very interesting spot right now. Gold is navigating the cross-currents of monetary policy and geopolitical risk, acting as that classic safe haven. Silver is playing its dual role, benefiting from both monetary interest and a powerful, long-term industrial demand story driven by the green energy revolution. The gold-to-silver ratio suggests that silver may have some room to run relative to gold. As always, this is not financial advice. It's essential to do your own research and consider your own financial situation and risk tolerance before making any investment decisions. The precious metals markets can be volatile, so it's important to be prepared for the ups and downs. I hope this analysis was helpful and gave you a clearer picture of what's happening in the gold and silver markets. What are your thoughts? Are you bullish on gold, silver, or both? Let me know down in the comments. I love reading your perspectives and getting a discussion going. Thanks so much for watching today. If you found this video valuable, please give it a thumbs up. And don't forget to subscribe to the channel and hit that notification bell so you don't miss our future market updates. We'll see you in the next video.